All right, let's dive into a pretty fascinating showdown that's happening right now in the world of AI infrastructure. We're looking at two key players, CoreWeave and Nebius, and their latest earnings reports tell a really dramatic story, a story about massive growth, the hunt for profit, and what Wall Street is betting on to power the future of AI. But let's kick things off with a bit of a head-scratcher. Just imagine, for a second, that your company completely crushes its revenue goals. You pull in over $1 billion in a single quarter. You'd be popping champagne, right? Well, for one of these companies, the market's reaction was to tank the stock. How on earth does that happen? Well, that's the puzzle we're going to piece together today. Okay, first things first, let's get to know the two companies at the heart of all this. I think the best way to look at this is like a classic boxing match. In one corner, you have the heavyweight champion, CoreWeave. They are the leader in scale. We're talking absolutely massive revenue and a backlog of orders that's just gigantic. And in the other corner, you've got the challenger, Nebius. They're the scrappy, efficient upstart showing just blistering growth and a laser focus on profit right from the start. So now let's go to the tail of the tape, their Q2 earnings reports, because the numbers here tell two completely different stories, and they show us exactly why the market reacted the way it did. First up, CoreWeave. I mean, wow. The scale here is just incredible. They pulled in $1.21 billion in revenue for the quarter, totally blowing past what everyone expected. This proves that the demand for what they're selling, AI compute power, is completely off the charts. But, and this is a huge but, all that amazing revenue came at a pretty steep price. CoreWeave posted a net loss of over $290 million. This is the number that really gave investors heartburn and started to flip the script. And when you zoom out, you see the full picture. The future looks great, right? A backlog of over $30 billion is insane. But the present is incredibly expensive. Their operating costs ballooned to almost $1.2 billion as they raced to get bigger. And they even pointed out a major bottleneck, just getting enough electrical power for their new data centers. So demand isn't the issue. The real problem is the sheer cost of meeting that demand. Okay, so that's the complicated story for a heavyweight champion. Now let's switch corners and see how the challenger, Nebius, is building a totally different picture for investors. Now, Nebius is definitely working on a smaller scale, about $105 million in revenue, but its growth rate is just nuts. It's up 106% from the last quarter. And get this, it's up 625% from the same time last year. That is pure, unadulterated hypergrowth. Now, before we get to their most important number, we need to quickly talk about a piece of financial jargon, adjusted EBITDA. It sounds complicated, but really just think of it as a quick health check on the company's main business, its day-to-day operations. It strips out stuff like interest and taxes to tell you, is the core business itself actually making money? And boom, this is the knockout punch for Nebius. Way ahead of schedule, they announced that their core business hit positive adjusted EBITDA. This sent a massive signal to the market, saying, hey, even at this early stage, our business model is fundamentally profitable. When you put it all side by side like this, the whole story just clicks into place. You've got CoreWeave with enormous revenue, but that's paired with a big loss and a stock drop. Then you have Nebius with smaller revenue, but it's matched with insane growth, a signal of profitability, and a stock that shot through the roof. It's like night and day. So why? Why did the market, which is really the ultimate judge in this fight, deliver such a clear and different verdict for each of them? It all comes down to what investors value most in this crazy AI gold rush. And this quote from one of the analysts just nails it. Right now, the winning formula isn't just grow at all costs. It's that magic combination of surging growth plus an early sign that the business is built on solid, profitable ground. Nebius served that up on a silver platter. So investors were left looking at two very different pitches. The CoreWeave story was all about incredible, undeniable scale and demand, but it was kind of overshadowed by all the cash they're burning through and the risk of just being able to pull it all off. The Nebius story, on the other hand, was smaller, sure, but it offered a much clearer, much earlier path to profit. And right now, that's the story investors wanted to buy into. But listen, this rivalry is far from over. This was just one round. As this whole thing heats up, what are the key things that we should all be watching for in the next few rounds between these two giants? I think it boils down to 4 key questions. Number 1, power. Who can actually get these new, power-hungry data centers built and turned on the fastest? 2. Unit economics. Can they prove their business is profitable and keep their costs under control as they add more customers? 3. Customer stickiness. How loyal are their big clients? Are they locked in for the long haul? And 4. CapEx discipline. CapEx is just the money they spend on big physical stuff like servers. The question is, who's spending that money smarter to build for the future? So here's the bottom line. The challenge for each company is basically the flip side of the other. For CoreWeave, it's all about taking that incredible leadership and scale and finally turning it into real profit. And for Nebius, they have to prove that they can keep their lean, efficient model working as they get bigger and bigger. And that really leaves us with the central question of this entire showdown. In this incredibly high-stakes race to build the infrastructure that's going to run our AI future, what matters more? Is it achieving massive dominant scale today, even if it means burning through cash? Or is it proving you have a clear, efficient path to profit tomorrow? The next few quarters are definitely going to be interesting.